The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
It's hard to understate the number of catalysts about to hit financial markets, from earnings to an inauguration to major economic data. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Bonnie Quinn, and let's take a look at where we stand now as we kick you off to the closing bells. We're actually unchanged on the S&P 500, but that's to belie the fact that we were down 0.9% at session lows. For the Nasdaq 100, it was actually a worse session, down 1.5% at session lows. It's down about 0.5% now, some dip buyers emerging in the chaos. The 10-year yield has just touched 480. That is an incredible move, another 4 basis points today as the market resets. The dollar index, look at this, we are about to hit 110 on the dollar index. I just want to mention that the euro is trading around 102 right now. It is perilously close to parity. And then NYMEX crude continues its upward march as well, up another 3% today, and that's having an impact on some stocks as well, Romaine.
Interesting to see the moves, 58.21, unchanged on the S&P 500. It did not look that the way just a couple of hours ago. Sentiment has been shifting, and sentiment around equities, at least for now, can certainly be explained by bond yields. According to Piper strategist Michael Kantrowitz, that correlation right now is the strongest it's been in 30 years. He says market weakness will more likely come up ahead from higher rates rather than softer economic growth, a dynamic he says has been unfolding since 2022. And I want you to remember, we had that hawkish surprise on the jobs report on Friday, yet the market reaction was more about what it meant for yields. That trend line actually became more evident in 2024, and it's heating up in 2025, a trend that has now sapped almost all of the S&P's election-related gains from the Trump bump. And for the Russell, which in November traded at an intraday record, that is now corrected, down almost 11% since. And today, threatening to close below its 200-day moving average for the first time in 13 months. Now, a hawkish surprise from U.S. data this week, including an inflation print this Wednesday and retail sales this Thursday, are certainly going to give investors a lot more to think about, more than they probably want to care to think about. And the case in point really is some of the disappointing apparel company forecasts that we've been getting coming out of that ICR conference in Florida this morning. That includes some interesting commentary from Macy's and Abercrombie. And then, of course, well, you have that new report from the New York Fed showing consumers are growing more pessimistic, Bonnie, about rising inflation.
Well, just on that note, Romaine, we are getting more inflation data, as you've been saying, later in the week. But I wanted to put the rise in yields into the context of a multi-year cycle. So if you look at this, we are back to cycle highs. This red line, well, that's the great financial crisis, would you believe? Now, obviously, it was a whole different economy. It was a whole different bond market. At the same time, we are right back up to where we were back then. 498 and 479 on the 10-year. In fact, we just hit 480 just a couple of moments ago. I want to point out that Bank of America and Mizuho among those who are seeing no interest rate increases or declines this year, so no moves whatsoever. We have Goldman and JP Morgan pulling back to 2 cuts from 3. But that conversation about potentially a hike being on the cards is back in the ether, Romaine. It's almost difficult to believe, except for, if you just take a look at this, Greg Peters calling this a tantrum-esque environment.
Let's kick you off to the close right now with Jimmy Chang, Chief Investment Officer at the Rockefeller Global Family Office, joining us here in Studio 2. And I want to go back to that note by Michael Kantrowitz over at Piper Sandler. He's not the only one on Wall Street. Everyone's looking at the bond market right now and saying, if they're an equity investor, you better be paying attention to what's going on there.
Yeah, the 10-year Treasury yield is a tail that's wagging the dog right now, and rightfully so, because the risk-free rates underpin the asset valuations, and it's competition for other assets. When you can get close to 5% risk-free, that's relatively pretty attractive. I would say technically it looks like it will try to challenge 5%. A lot depends on where the inflation data comes in the next few days. But I would suspect once it gets above 5%, it starts to look interesting, just because at some point higher rates will pressure the economy, and when things eventually slow down, I do suspect yield will trade lower subsequently.
It's kind of interesting you said that. There was another note out of HSBC saying something similar, that once the rate gets to that level, for certain folks, it's actually going to create a buying opportunity, not only in the bond market, but of course in the stock market as well. I am curious. I know it's kind of difficult to kind of have a crystal ball and look forward, particularly with the new administration coming in, but we're kind of at that point where you have to start doing that. We have an inauguration a week away. You have some big inflation data coming out this week, a Fed meeting at the end of this month here. Do you have confidence in the economic backdrop? Not necessarily saying where yields are going to go or where stocks will go, but do you think the economy is in a position where it will hold up? It will be, if not strong, at least stable?
I think near term the economy looks okay. The issue is the longer yields stay higher, around 5+%, and 30-year mortgage rate way above 7%, that pressures the economy. I think the December jobs data was reassuring to the market, but we still don't know, is it a one-month fluke or not? I do have the sense that things will continue to lose a bit of momentum because we're coming off 5 years of extremely high stimulus. And there's really not much left, not much room for the new administration to stimulate. If you look at the deficit, we now have a structurally high 6% of GDP. If you look at net interest payment, it's now over 3% of GDP. Whereas 8 years ago, when Trump came in for his first term, back then the deficit was 3% of GDP. Financing cost was 1.3% of GDP.
Have you ever seen an environment where we've gone to the potential for 7 interest rate cuts to 0 within the space of 12 months? So it's pretty incredible, right? And we're just going on data point to data point to data point, and there have been so many whiplash moments in this market.
Yeah, I think the biggest surprise to the Fed is that when they started easing in September, they probably didn't anticipate that the 10-year Treasury yield will actually go up more than 100 basis points after they cut cumulatively 100 basis points. That is unprecedented historically. But then we're looking at a very unusual circumstance with the new administration coming in with the America First agenda, pro-growth and yet pro-tariffs, potentially inflationary.
When do we get an even bigger move then? Or have we got the Trump administration and its potential for 20% tariffs extra on some Chinese goods? Is that priced into this bond market?
I don't think it's totally priced into the bond market yet. I think a lot of people are still hoping perhaps the bites of tariffs won't be as severe in the sense that it would be good for the market if he were to announce tariffs but set the kickoff date, let's say 18 months from now, to give time for companies to make the adjustment. That would be viewed as somewhat bullish to the market in that you don't get that inflationary pressure right away. You also have more manufacturing coming back that's pro-growth. However, if you were to impose something and put it into effect relatively quickly, that will then potentially lead to more disruption to the market because of the fear of inflation coming back.
There's an interesting kind of dynamic in this market right now because despite the sell-off that we've been seeing over the past few days in equities, when you talk to other folks kind of behind the scenes, sort of the bankers and the deal makers out there, they're pretty optimistic about what the next year or so may hold for them. We've already seen quite a few deals announced just over the past few weeks. Whether we can connect that directly to the election, that's a whole nother conversation. But certainly the appetite in the deal-making space is a lot different today than what it was a year ago.
Yeah, it depends on what segments of the economy you are in. For those involved in the investment banking, M&A space, there is a lot of momentum just because of potential deregulation. It's a more pro-transaction environment. So I do believe that we will see more M&A volumes, and that will benefit investment banking, certain private equity investments.
Part of that, though, of course, and it gets to the idea as well with the Trump administration and the U.S. relationship with other nations. Today, there's a lot of back and forth about this Nippon Steel deal, whether that could go through or maybe not go through, whether cross-border transactions will actually even be a thing over the next few years.
I would think it depends on what's the net impact to American economy. I think the new administration will prefer foreigners making investment domestically in the U.S. So that will
putting the money
make a
right
difference.
Here.
Exactly. Invest here, create jobs domestically.
Okay.
Earnings season imminent. I mean, we're talking JP Morgan in 2 days' time, right? What are you anticipating for earnings season? Do you have a little cash on the sidelines in case everything goes sour?
I would think for Q4, we're probably okay. My main concern is really the double-digit earnings growth projection for 2025. It's actually not that easy to get to double-digit growth after a year where you've already grown double-digit in 2024. In fact, we look back to post-Great Financial Crisis. Over the last 16 years, there were only 6 years when we had double-digit earnings growth. 2 of them came off weak earnings during recession. That was 2010 and 2021. 1 year was 2018, where it had this huge tax cuts, right, when the corporate tax rate went from 35% down to 21%. The other 2 occasions were coming off flattish years. So you get about, averaging about, 5-6% over 2 years. So the only year that had a clean double-digit growth was in 2011. So to assume 2025 will generate 13-14% EPS growth, which is the consensus, I think that will be challenging.
And then, Jimmy, I want to ask your thoughts about, the next theatre. So the theatre has been the bond market, right, at least for the last few weeks. Do we move to the dollar very shortly, particularly given President Trump's concern about the dollar or the incoming president? I mean, we're at close to 110 now on DXY.
Yeah, there's some suspect that we may have another Plaza Accord, some kind of arrangement. It could be part of the trade deal in negotiating with China and other countries, because certainly the administration would like to have a weaker dollar to help exports. But at the same time, the pro-America, America First policies will drive U.S. dollar even stronger. So there lies the inconsistency. So something has to be worked out.
Jimmy, always a great conversation. We'll catch up with you again soon, I'm sure. Rockefeller Global Family Office CIO Jimmy Chang kicking us off to the close here on this Monday afternoon. A little bit later in the program, we're going to talk about the health of the ski industry, a conversation with Olympic ski legend Bode Miller in his latest mountain of an endeavor.
Plus, a slew of headlines hitting the tape today related to the deal-making space. Is it a sign of the level of activity that we'll see throughout the year? We'll break down what to expect.
And firefighters in Los Angeles still trying to contain those devastating wildfires. We're going to talk about the overarching impact on LA, a conversation about the impact on the electrical grid with the head of California's second largest utility, and a conversation about a climate scientist who fled those fires, moving his family to the East Coast, and he said things may not get better.
Honeywell getting ready to proceed with a breakup following pressure from activist Elliott Investment Management. This all according to people familiar with the matter. The industrial conglomerate is planning to split into two independent publicly traded companies, one focused on automation and the other on aerospace and defense. Joining us to discuss is Bloomberg's Liana Baker. So, Liana, we knew that Elliott was putting pressure on Honeywell. How did it come to this, where now we have the announcement, according to people familiar with the matter, of an actual breakup?
From the beginning, this has been moving really smoothly. We haven't seen that kind of aggressive stance that you sometimes see by activists and companies. These aren't, two sides fighting. It felt in many ways like Elliott was knocking on an open door. Many of Honeywell's competitors, like GE, have been doing breakups for some time. And Honeywell was kind of the last man standing as a big conglomerate. The trend really is to do these big, carve-outs.
Well, that's the funny thing. I kind of chuckled when I saw the headline, because I was like, did you really need an activist investor to move this along? I mean, it kind of felt like this was going to happen maybe organically, maybe not fast enough for Elliott and some of the other activists.
It still hasn't happened yet. Nothing's
yes,
official,
right.
And we'll see earnings next month.
Thanks for that clarification. But we talk about this idea of sort of what is the potential upside value for investors, that is, of a breakup. Has that been sort of articulated by Elliott?
So the analysts, not just Elliott, but the research analysts are trying to figure that out. But what we'll be following on the deals team is whether these companies will be doing M&A, or will they have a partner? Once you start to do a breakup, that's when investment bankers pull out their playbooks and see what kind of deal-making machinations could be next.
And Honeywell had a big spike on the news, up only about 0.4% now, although we are in a very down market, so that's not maybe a terrible move. I want to ask you a little bit about the J&J deal. What kind of company are they buying? Why is this such a big move for Johnson & Johnson?
In general, there hasn't been a lot of biotech activity, and this is the biggest acquisition in biotech in over a year. And J&J is buying this company which makes psychiatric drugs, and they noted in their press release that we're in a mental health crisis here in the U.S., and many people have these issues, and these drugs so far, could treat that. So definitely something that is an issue for them to deal with.
We've seen a couple other deals in the pharmaceutical or the broader, healthcare space, if you will. That seems to be an area that, particularly when we've talked with deal makers on Wall Street, that they think we're going to see a lot more activity. Specifically with this J&J deal, I know, was this kind of like a long time in the making, or did this just kind of crop up recently? What?
So we reported today that this deal makes sense because they already had a partnership, but until we broke it on Sunday, no one had really been writing about Intracellular. Both companies are based in New Jersey, but there's a lot of companies in the space in New Jersey. Yeah. We'll be watching to see what J&J does next. They did a spin-off themselves back to carve-out, so they have firepower to do different deals now that they don't have a consumer business.
Intracellular up about 34% now. Talk to us a little bit about the Cleveland Cliffs Nucor potential acquisition of U.S. Steel, assuming that Nippon isn't going ahead.
So this is really interesting because since the Nippon deal sort of got scrapped, scrap metal, we've been following to see Cleveland Cliffs, which was a huge opponent of that deal, to see if they emerge. And today in Pittsburgh, the CEO did say this is something he's still interested in. Partnering with Nucor would be interesting. We reported that Nucor would be interested in the crown jewels, which are the mini mills, as you call it, and that the U.S. blast furnaces would go to Cliff. So this is not imminent, and we'll be seeing how this plays out. There's still a lot of question marks, but it would be interesting if we could see, two companies team up to do this deal.
All right, Liana Baker helps lead our deals coverage, and a lot of deals to talk about today, including that J&J deal, rumors, of course, about a few others, Nippon Steel, who knows what's going to happen with that as well, and maybe Elliott trying to facilitate potential breakup of Honeywell. Meanwhile, a lot of news in the retail and apparel space. Now, 2024 saw a solid holiday shopping season, but not everyone is reaping the benefits. Coming up next in our top calls, we're going to get a check on what to expect from the sector this year. This is The Close on Bloomberg. All right, time now for our top calls, the big movers on the back of analyst recommendations. And we're going to start today with Constellation Brands. This is the maker of Corona and Modelo beers. JP Morgan actually telling investors, hold the tab with a downgrade today to neutral, citing a pullback in demand, potential Trump policies on tariffs and immigration, and that Surgeon General's cancer advisory, each putting additional pressure on the alcohol industry. Shareholders, though, shrugging that off, pushing them up by 3%. Next up, Pinterest cut to hold over at Jefferies, the price target going down to 32 from 40. The analyst saying the rollout of new products like its AI advertising feature are just a bit too novel to drive growth. He also says the pace of margin expansion may slow after 2 years of optimizing infrastructure costs. Those shares down 1% on the day. And let's take a look at Elf Beauty. Morgan Stanley flagging an opportune entry point for the cosmetics company with an upgrade to overweight. The analyst seeing upside from strong international growth. It sells Elf's attractive growth outlook, not quite priced into those shares. Those shares, though, trying to price it in today, up about 4.5%. And those are some of our top calls. We do want to say in the retail space right now, with a closer look at U.S. consumer spending, it did hold up for most of 2024, but the sector is still challenged by weakening demand for goods, especially across discretionary categories like apparel. That could impact companies like Macy's, like Walmart, like Target. Let's get some insight as to what to expect this year from Mike Baker, analyst over at D.A. Davidson. And Mike, we got to start off here with the news that we got out of Macy's this morning here. This is a company, obviously, that's dealing with a lot of idiosyncratic issues. But when we start to see some of these sales forecast numbers, these growth numbers or lack of growth numbers here, what should investors make of that? Is this something temporary that Macy's can work through, or are we looking at a longer-term structural decline?
Well, I think department stores have been in a long-term structural decline, and it's been really going on for years. Some of the department stores are doing better than others. I think Nordstrom's had a little bit of a better announcement today, but generally speaking, department stores are in a long-term secular decline. Now, retail sales, as you said, held up reasonably well in 2024, and we actually had a really good holiday period despite the compressed season. But 2024 in total was not a great year for consumer spending, one of the weakest years really since the Great Recession. So you sort of have two negatives there for Macy's. You have just retail sales in general being a little bit softer for the full year, and also I believe department stores losing market share.
I'm just curious, and just to stay on that point, though, I mean, you have, the relatively new CEO, Tony Spring, there trying to make some closing stores and make changes to the stores that he wants to keep to make them more palatable. When you look at the companies that did do well during the holiday season, Mike, what did they do right that maybe some of the department stores and others didn't quite get?
Well, the ones that are doing really well, we think, are going to end up being the ones who did well all year. That's Walmart, Amazon, Costco put up really good same-store sales numbers when they reported their December month last week. And they've just been long-term share gainers. I think they have very good omni-channel strategies. They obviously have good pricing, so the consumer is still looking for discounting. So we just feel like it's a secular trend, again, long-term, away from department stores, more towards companies that have a little bit more value, but also a really strong omni-channel presence.
Mike, are you turning more positive then on Costco? At the moment, you have a neutral on it and it's trading above your price target.
Yeah, and to be fair, that has been a valuation call. It's trading at 50 times earnings. A year ago, I would have said something along the lines of it's trading at 35 times earnings. That multiple can't possibly get higher. And of course, I was wrong because the multiple has gotten higher. At 50 times earnings, it's hard for us to see a lot of multiple upside. The way actually we like to play that trend is BJ's. A smaller company basically does the same thing as Costco in the warehouse space. We think they're doing well also, and their stock has been just as good as Costco, so at a much lower valuation. So that's sort of our answer to the Costco question.
Yeah, Mike, Romain earlier mentioned the call on ELF, and I'm just curious as to your opinion on Ulta as well. You're also very positive on Ulta. It's trading, more than 20% below what your price target is for that company. Is it that consumers are able to buy something that's maybe a lower price point, and that's why these cosmetics retailers are benefiting potentially?
Sure, a sort of low price luxury, if you will. Ulta had some issues in the end of 2023 and a lot of 2024, really when Sephora was rolling out their store within a store concept in Kohl's. And that was a really big competitive pressure for Ulta. We feel like the worst of that is behind us. That has been fully rolled out now for about 2 or 3 quarters. So Ulta's starting to sort of come out the other end of that. They pre-announced a better than expected fourth quarter. That will be the second quarter in a row of positive same-store sales after they had a negative one in the second quarter. So we do feel like the worst is behind them. Now, Amazon has done more in beauty. Amazon is taking share. That's something that Ulta is still fighting through. But for much of 2024, it was that Sephora issue and Amazon. Now we feel like with that Sephora issue behind them, things should get better from here for them.
All right, Mike, thank you so much for giving us some of your time today. Looking forward to our next conversation. That's Mike Baker over at D.A. Davidson. And Romain, I know you were pointing this out to me earlier. Starbucks rolling out a new, what they're calling a code of conduct, which requires everybody, I guess, in the store to be buying something in the store?
Yeah, I guess this is the Wall Street Journal is reporting this, of course, citing up people familiar. But I guess they have this policy they're going to start to implement that basically says you just can't linger there unless you buy something. I mean, let's face it. I mean, you've been to Starbucks before, right? There are a lot of people that they're just there.
When they got rid of the CDs, I stopped browsing in Starbucks.
The CDs.
Remember they used to have a CD every month. This is before Romain's time. Obviously, I'm dating myself. No, but there's nothing to browse in Starbucks. So if you're going in. Yeah.
Gotcha.
You're either a malingerer or a coffee drinker, I guess, right?
Yeah, absolutely. All right, we, of course, need to turn back to some more serious issues here. We're going to go back out to Los Angeles with a check-in here on the wildfires and a focus on the utilities, a conversation with Pedro Pizarro, Edison International President and CEO. You're looking at live footage right now from the Altadena neighborhood in Los Angeles as we continue to monitor the wildfires and the devastating effects there. The official numbers right now, more than 100,000 residents are still under evacuation orders. More than 40,000 acres across Los Angeles have already been scorched. And there are tens of thousands of other people who right now are under evacuation warnings. At least 24 deaths right now as firefighters still try to contain. Altadena, of course, affected most by the Eaton fire, which has still not been contained, only about 33% contained as of about 3 p.m. East Coast time. The Palisades fire, which of course has affected areas that abut Malibu, Brentwood, and some of the other wealthy areas of Los Angeles. That containment, Bonnie Quinn, is only now at about 14%.
Unbelievable the amount of work that is going on out there in order to try and contain these fires, and more difficult conditions again this week, Romain. We're watching those shares of Edison International decline the most in almost 5 years. This comes after its Southern California utility was hit with a lawsuit pointing the finger at its equipment for igniting the deadly wildfires that we've just been speaking about in the LA area. Joining us from its California Emergency Operations Center is Pedro Pizarro, President and CEO of Edison International. And Pedro, very, very difficult times for obviously the residents of Los Angeles, their families, and yourselves, no doubt, as well. First of all, can you give us an update of any estimates you have of the damage?
Yeah, so thank you for having me. And it is a difficult time. And let me just start by saying our hearts just go out to everybody who's been impacted. You were showing footage of Altadena. My wife and I have lived in Pasadena right next door for almost 37 years. This isn't just close to home, this is home. And so it's very painful to see this. 19 of our Edison team members have lost their homes. We know many others have across the area. And so I think the damage across the Eaton fire and the Palisades fire is well over 40,000 acres that have been covered with fire. I think you're seeing estimates out there of structure counts, but still early here. And so I'm afraid we're going to hear numbers climb for a bit as an assessment is made. On the electrical side, we had at one point over 500,000 customers out without power because of the extreme winds that our area experienced, up to 90 mile an hour, as much as 100 mile an hour gusts. A little bit of constructive news there. Our team has been able to work very quickly and bring those numbers down. So right now we're sitting around 40,000 customers out, with about 30,000 of those being impacted by public safety power shutoffs. So I really want to give some credit to the firefighters who've worked so tirelessly, the first responders, and our utility workers as well.
Yeah, absolutely. Pedro, I have to ask you though, why did the company have its transmission lines and distribution lines energized at the beginning of the fire, particularly obviously in Eaton?
So we have very clear protocols under which we de-energize lines, and they're part of a broader set of wildfire mitigation plan that is overseen by a state Office of Energy Infrastructure Safety and approved by them. They're ratified by the Public Utilities Commission. And so there's criteria for when and how we de-energize, and recognize that while de-energizing lines removes fire risk, it creates other risks for our customers and communities. And so that's why the protocols are important. They're dependent on factors like how much fuel there might be on the ground, how wet that or dry that might be, ambient humidity, and importantly, wind speed. Let me focus on the Eaton Canyon fire in particular, because that's the one with the images that you're showing right now, and the largest one in focus within our service territory. There were two sets of lines around the reported origin point. One set of lines were distribution lines, or lower voltage lines that serve the community. Those used covered conductor, insulated wire, and they had been de-energized 2 hours prior to the reported start of the fire. So those were de-energized. We also had transmission lines, higher voltage, on the other side of the canyon. Those were not de-energized, and that's because they had not met the criteria for that. Transmission lines are larger, stronger, and so they can operate safely at higher wind speeds. Maybe one more thing quickly I'll share is that certainly we've seen the video images and photos that are in the media that a number of residents have taken showing flames near our towers. Up to date, we have not seen in our telemetry any indication of an electrical anomaly. And typically when you have a fire caused by electrical infrastructure, you do see a signature, voltage dropping, current increasing. We have not seen that in our study, going back 12 hours before the reported time of the started time of the fire. Right. We do see a signature about over an hour after the start. We have not been able to get up close to the lines still because of fire agencies are still working in the area. We expect we'll be able to get in shortly, and we'll certainly want to inspect and see if is there some unique event that happened that wasn't picked up by our telemetry. Above all, we will be transparent with our community as we learn more.
So Pedro, I mean, I understand the difficulty of trying to get to these sites while the fires, of course, are still going on. But has there been any efforts at all, either through your own folks or through other authorities, to preserve what could be evidence in these investigations?
Always, Romain. And to the extent that there's any question, you saw that we filed an incident report with our state regulator for the Eaton fire as well as for the Hearst fire. When we do that, we'll do it because it satisfied one of a number of criteria, but we preserve evidence because we know that there may be alternate theories out there. We in fact, believe that a complaint has been announced already for the Eaton fire. We have not been served that yet, so we haven't seen it. But we have the full expectation there may be litigation, and above all, we want to make sure that we preserve the evidence for good, robust investigation.
Well, let me tell you what it says. I mean, our Bloomberg reporters have seen it, and a lot of this will sound familiar. I mean, we've been here before with these wildfires, and your company has been here before with some of those as well. Not just the fact that, or I shouldn't say the fact, excuse me, but the allegation that they're making in this lawsuit that one of your power poles may have caused the fire, but more importantly, some of the longstanding issues with the updating of infrastructure and whether the lack of updating of that infrastructure may have been contributory to any of the fires or the acceleration of those fires.
Well, we haven't seen the complaint yet. Thanks for sharing that with us. We'll obviously study it when we get it. But let me address some of the topics in there. Importantly, we operate under wildfire mitigation plans, again, that are approved by our state regulators and overseen by them. There's a lot of rigor now that frankly wasn't there back in 2017 and 2018 when California first experienced major catastrophic fires. So how we harden our system, how we have deployed over 6,000 miles of insulated wire covered conductor in the last several years, how we deployed other equipment, how we use public safety power shutoffs, how we monitor with high definition cameras and weather stations, all of that operational protocols. That's embodied in these wildfire mitigation plans, again, with very robust oversight from our regulators. Moreover, since 2017 and 2018, the state passed new laws, notably AB 1054, passed in 2019, that really strengthened the regulatory compact, the framework in California for dealing with wildfire. It requires those wildfire mitigation plans. Importantly, it also set up a wildfire mitigation, wildfire liability fund, $21 billion fund, funded partly by customers, partly by shareholders of investor-owned utilities. So there's a pool of $21 billion there so that recognizing that there's extreme weather, if the hardening wasn't enough to prevent that spark, if the great firefighting that we have now in the state didn't contain the fire, we have a mitigation framework to deal with the liability.
But Pedro, were there any anomalies detected by Southern California Edison at that time? Because one of the allegations in the lawsuit are eyewitness accounts of a fire beneath the pole, which they're saying was an active wire. Again, they're saying that. And I'm wondering if there was any evidence on your end for that to be true.
Yeah, Romain, as I shared a minute ago, no. To date, we have not seen that. We have telemetry. We have the voltages, the currents. We've monitored all of that. We have not seen any of the signatures that you typically see when a line causes a fire. But again, we have not been able to get up close. And so we want to do that with assistance from investigators, and we'll be transparent with the public if we find something.
Pedro, you just mentioned that fund up to $1 billion. This is California's inverse condemnation law, which would allow for Edison International to pay even if negligence were not proved. That fund is currently valued at about $14.7 billion. But in a scenario as awful as this, you could imagine that would be depleted really quickly. What would happen in that case? Have you thought about it? Would it be ratepayers and yourselves, utilities, that would have to fund it again?
Yeah, we reassure our investors about this. This is a question we get a lot. So that fund is meant to be $21 billion. You're right, the cash in it is not 21 today, but it has the force of statute. And so the authority that manages that fund has the ability to finance and get access to $21 billion. That amount was estimated when the fund was set up to last for at least 10 years, 94% probability of lasting for 10 years based on fire history. We don't know yet what the damage will be from the Eaton fire or whether liability will ultimately be assigned to our utility. But I will say that the law also has a provision that's meant to first protect customers, right, through the wildfire mitigation plans and the accountability for the utilities. Secondly, the fund is there to have cash to ultimately help individuals impacted by the fire. But importantly, when the fund was set up, when the law was set up, there was a recognition that utilities, A, needed to be held accountable, but B, needed to have an ability to remain financially healthy. And so the law also includes provisions for a cap on the liability that our shareholders might face were we to be found not just liable, but imprudent. Because the standard here is not perfection, it's prudency. And just from an investor perspective, If you look at our market value, we have dropped about between $8 and $9 billion in market cap since the beginning of the fire. Our liability cap is $3.9 billion. So part of our job right now is to make sure that we're communicating with investors the details, the facts of this law, and how it helps to support the financial health of our utility.
Well, I appreciate you answering some tough questions, Pedro. I know you have a lot of work to do as the head of this company, but my final question is not to you as a corporate executive, but as a resident of Los Angeles. We spoke with a couple folks on our show on Friday who were in the Palisades area, who lost their homes in the Palisades area. They're very pessimistic about whether that area and some of the surrounding areas will ever be rebuilt. They're concerned about the cost and the logistics of it, and saying that short of a massive federal intervention of some kind, that these communities, at least for the foreseeable future, may be no more. Do you have any hope, any optimism that we will see a coordinated rebuilding effort that will get these communities back at least close to what they were before?
I do. And the reason is there are real American lives at stake here and livelihoods. California and Southern California is frankly a wonderful place. I've lived here for nearly 37 years, and I know that the business community and government are going to band together to bring our communities back, whether it's the Palisades, it's Altadena, other areas impacted. So certainly as Edison, we're ready to roll up our sleeves. We announced that we're committing $1 million of shareholder funding towards charitable efforts to help rebuild the area. I know other companies are as well. Governor Newsom has come out on record already talking about wanting to expedite processes and provide support here. And so we're looking forward to working with our neighbors. This is our home, and we're here to stay, and we're going to help.
All right, Pedro. Well, we wish you the best, of course, and we'll catch up with you again sometime soon, I'm sure. Pedro Pizarro, the president and CEO of Edison International. We do want to turn back to the markets here as we count you down to the close and take a look at some of the big movers on the day. And that includes Moderna, the worst performer in the S&P 500 today. This after the vaccine maker slashed its revenue guidance for 2025. Emily Grafeo joins us right now to talk a little bit more about what's ailing this stock. And I feel like we've had you on before to talk about what's ailing this stock. What's new today?
So they cut their revenue guidance, like you said, and it was actually it was lower than even estimates. So they now see revenue $1.5 billion to $2.5 billion for 2025. They saw $2.5 to $3.5 billion, and estimates were about $2.9 billion. We actually had our very own Bloomberg intelligence analyst, Sam Fazeli, say that the revenue guidance is, quote, shockingly low. And what's causing this? It's the dwindling sales of their COVID-19 vaccine. That's their big product. They don't have many out. They don't have a lot of commercial products. This was a big one. Less people are getting COVID vaccines.
Right, and also the prospect of potentially an HHS secretary that doesn't believe in vaccines whatsoever, and this is a very vaccine-specific company.
Yeah, there's a lot of uncertainty about what's going to happen with the new Trump administration. As you said, with potentially someone who's a skeptic of vaccines, and this is their big product. They also have an RSV vaccine, but there's some still headwinds, at least according to the CFO. He said in an interview that this forecast reflects several headwinds. One is just delays with facilities that the company's building out, and then also that competition again in the COVID market.
I mean, if it's any consolation, there is the potential for more vaccines to be needed in the further out future, right, of some of these diseases that are coming back that we associate with children are coming back now into the adult sphere. I was reading about that earlier on, that things like whooping cough and so on are being contracted more and more by adults as well. All right, Emily, thank you so much. That is Bloomberg's Emily Grafeo there with our stock of the hour. Coming up, we count you down to the closing bell with Shelby McFaddin, senior analyst with Motley Fool Asset Management. This is The Close on Bloomberg.
the December jobs data was reassuring to the market, but we still don't know is it a 1 month fluke or not. I do have the sense that things will continue to lose a bit of momentum because we're coming off 5 years of extremely high stimulus. And there's really not much left, not much room for the new administration to stimulate.
A strong economy and, well, concerns about a strong economy. Jimmy Chang, Chief Investment Officer at the Rockefeller Global Family Office. He kicked us off to the show just about 50 minutes ago. Romaine Bostic here alongside Bonnie Quinn. And the market has had a wild ride today. We had an S&P that looked like it was set to crash.
Yeah, absolutely. And I like how you grinned a little bit when you said, a strong economy is giving this market fright.
Yeah.
And it is a little bit ironic, right? A bumper jobs report and the market bemoans it. But I mean, you understand why. We all understand why.
Well, I think why we all understand why is that second line on the screen there, 4.8, almost 4.8 on a 10-year. And some people saying that's going to get up to 10.
Yeah, exactly.
5%, excuse me.
5%, yeah. And then the question is, does that slow the economy and how long does it take for it to do that?
Yeah.
The dollar index, though, at 110, we're going to feel that as well, Romaine. And we might get a big reversal, after Donald Trump takes office. He's always talked about having a weaker dollar, for example. And then, of course, oil up 2.8% as well. And that's going to hit people in the pocketbooks too. Yeah,
well, the good news, if we had started this show 3 or 4 hours ago, we would be talking about a market deep in the red. But right now, the only major index in the red is the NASDAQ Composite and the NASDAQ 100, and they're still only down about 4 to 0.5%. Everything else right now holding in the green with just about 8 minutes to go until we get to those closing bells. Shelby McFaddin joins us here in Studio 2, senior analyst with Motley Asset Management. I'm a little tongue-tied today, but I think I got it right there.
That's all right.
Shelby, it kind of makes sense of this because I think we look at that sell-off that we had leading up to today, and maybe we get a continuation of that. And a lot of that seems to be predicated on this idea that, the economy's doing well, but of course the economy might also be inflationary in a way that we kind of thought we had put behind us.
Sure. Yeah, I think you're absolutely starting to see that. And the reason I think that we see it in a little sort of chip-offs rather than a really large sell-off event is because when we look at the alternative, when we look at fixed income, we say, well, it's not super attractive either unless you're in a really technical, active, high-yield space, right? So when you come back to equities, I think investors are starting to take individual looks at parts of their portfolio and say, let's take a little bit off the table here. Let's take a little bit off the table here. When we think about how the NASDAQ is doing, one of the discussions I had earlier was the fact that in 21, 22, that bigger tech sell-off that we saw when rates were going up and starting to look like they were staying up, that was really them starting to realize, okay, we need to get rid of some of these excesses, and they have neglected to make those same mistakes again. So the bigger tech sell-offs, I think we don't see as much.
Yeah.
It's more so just like a little bit of corrective positioning there because they're not making the same mistakes.
It's kind of interesting, too. I mean, we talk about, right now, all the Mag 7, I think Tesla's the only other Mag 7 that's in the green on the day, and some pretty big declines for Apple because of concerns about iPhone sales. And we talk about the health of the consumer.
Right.
There's that ICR conference going on down in Florida, and we had some commentary out of Macy's and a few other retailers, and some of them aren't doing too well. Macy's has its own issues, we know that, but Abercrombie, which had been doing great last year, down 16% today. But then you had other retailers like Urban Outfitters and a few others, they're saying, hey, not only were things great last year, they're going to be great again in 2025. So what am I supposed to make of that?
Well, I think what you make of that is the perfect case for active management. So if we take a look at something like Macy's, in a similar, or in the same article that I read about Macy's, I read about Nordstrom doing very well. So we know that Nordstrom has gone private, but at the end of the day, the business hasn't changed fundamentally on the whole, right? Then when you want to make that example again, Urban Outfitters, you're looking at what they are providing in terms of value and then what is their actual identity. We had discussed that when it came to Starbucks, not retail, but when they changed their CEO and they realized they need to figure out what their brand identity is and do customers align with that in good times and in tough times. And so it seems that whatever Abercrombie has been trying to make of itself is not necessarily the brand identity that customers may be after when you combine it with the value that they provide. So that's where active management sort of steps in, and that's why we're so big on completing that full 4-pillar analysis at Motley Asset Management.
Sure. You mentioned that treasuries were not at all attractive, but we're at levels now where you might think that they'd be an attractive entry point, no?
Well, treasuries, sure. If you're looking at something that's a little bit more short term, especially if you're looking at inflation protected, and then you're also integrating more of a strategy with that, that's one thing. But if we're looking just at regular investment grade, longer term for price appreciation, that might not be as attractive. But if you're a high yield investor and you're going on that specific sort of strategy where you are actively managing that, then it could be a bit more attractive if you are purely looking for yield. But if you're going for price appreciation, it might be a little bit less attractive in that instance when we're comparing to stocks, just the broad stock market.
Now, you do have some stock picks for us, and one of them is Netflix. Why Netflix? Will it win the streaming wars? Is it doing the right thing with these sort of, NFL games?
Yeah, what we find about Netflix that's interesting is that they are increasing the level of competition in that entire market, and not just what the broadcasters need to provide, but also what the different sort of sports entities need to come up with. So when we look at the fact that F1 now is becoming increasingly more interesting in the United States, and it's something very technical, and it's something that you or I will most likely never get the chance to do because it is a multi-billionaire sport, but they're capturing this market. The opportunity for more sports to be broadcasted on various networks is also forcing more competition and more excitement in sports that may not have gotten that amount of coverage. So this is something we love to see. We want to see more players come into a space, not just for competition, but that's GDP. You're creating more money.
It's interesting because I was talking with another analyst about when they kind of started down this road in Netflix, and he said, this is kind of what made Netflix, not sports per se, but the idea of the pivot, the idea that they kind of understand the times are changing, habits are changing, and they need to change with it.
Absolutely. And I mean, when you think about it, short, that Tyson fight was a bit rough for them.
Was that an actual fight? I don't know what the heck that was.
But.
I can smell legal on me for that one. But, they cleaned it up really quickly. They're not a traditional broadcaster, right? So the journalism is going to have a different feel. It may not be the caliber that we're all used to from our favorite station, but they did decently well for Christmas, and they're bringing in talent that other broadcast networks can't always afford. So I think they're on the right track.
Yeah, I mean, they had to do well, right? Beyonce was completely trolling them right before with her ad, which had the buffering on it.
Yeah.
All right, Shelby, great to have you as always. Shelby McFaddin, senior analyst with Motley Fool Asset Management, counting us down to those closing bells, just about 3 minutes away, and a decidedly different story here at 3:57 in New York than what it would have been at maybe 1:57 or even 11:57. Right now, at least 6 of the S&P sectors in the green, Bonnie, more than 300 of the S&P stocks now holding on to gains.
Yeah, quite the unimaginable turnaround. It's not like we've had any major news. We did have a few bits of deal news, and maybe that has injected some life into this market, but also, of course, oil continuing to rise, the dollar continuing to rise, and maybe it's just the fact that we're getting closer to earnings than that inauguration.
Should be pointed out here when we talk about stocks and what the stock market is doing right now. Who are the leaders right now in the S&P 500, Vonnie? It's Mosaic, it's CVS Health. It's actually not the Mag 7. I mean, tech is not leading this for a change.
Tech is not leading. Tech is the laggard. We have energy stocks, we have materials, we have real estate stocks. We're going to be talking about real estate. We get earnings actually starting today for real estate.
A full breakdown of all your market coverage right here on Bloomberg. That breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Bonnie Quinn, taking you through the closing bell. A global simulcast starts right now. Carol Masser and Tim Stenovic joining us in the radio booth. Scarlett Fu and Alex Seal have the day off. We welcome our audiences across all of our Bloomberg platforms to parse the most crucial moments of the day. And Carol, what a turnaround from what this market was signaling just a few hours ago.
Yeah, just a few minutes ago, I was saying, the S&P and the NASDAQ 100 were still in the red, even though they were off their worst levels. But right now, we've got the S&P 500 actually up 11 points. So we're seeing, Romaine, some buying here into the close.
Look, I'm not going to, Alex isn't here, so one of you is going to talk about the bond market. That's certainly a big part of the story today, Vonnie. We'll see what happens later this week when we get CPI also. Could this be a peak on the 10-year yield, at least for this cycle?
Well, I'm not calling it, Tim. You can if you want, but there's no way I'm making that call. Tell you what, though, if you look at the map of the equity market today, particularly the S&P 500, Romaine was just mentioning it, we are looking at companies that we probably haven't had to say the name of in a long time. Materials companies like Corteva, for example, doing well. Industrials doing well. Energy doing well on the back of higher energy prices, oil and natural gas, it should be said. And, financials, we're about to head into financials close earnings season. Real estate, too, interestingly.
And the question is whether or not that's a good sign. 6 of the 7 of the Mag 7 in the red on the day, yet you still have a market here now holding into the green with just about a few seconds left before the bells. We should point out the VIX, which had been elevated earlier in the day, trading above 22, now back down to that 19 level, and similar strength that you saw in the dollar, fading just a touch here on this Monday afternoon. The closing bells giving folks, a little bit to cheer about. The Dow Jones Industrial Average, that's your primary gainer on the day, up about 0.9% as we wait for these numbers to settle. A gain of more than 300 points, about 361 points. We should point out Dow Transport's also up about 0.9% as well. The S&P 500 looks like it's going to close higher by roughly 9 points, right around 58.36, up about 0.2%. The NASDAQ Composite and the NASDAQ 100, those are your two outliers. Both going to close in the red, down about 3 to 0.4%. And the Russell 2000, which earlier in the day was down about 11% from that intraday high that it hit back in November, clawing its way back into the green, a gain today of 5 points or 0.2%.
Wow, interesting to see this move around. And you wonder about what was that late market sentiment. I'm looking at the S&P 500 once again, and you have most names, Vonnie, in the index higher today, 377 to be exact, 123 to the downside, 3 unchanged.
Yeah, and if you look at the map, as I was saying, all of those energy-related names, all of those deal-related names are higher, and that's pushing some of those sectors higher that you haven't seen higher in a while, like industrials, energy, healthcare, for example, financials. But you also have those lower information technology down 0.9%, utilities, and we all know why that is, down 1.2%. We were speaking with Pedro Pizarro earlier on a very, very difficult situation out in Los Angeles, and of course that is impacting the entirety of the utilities sector today.
Yeah, certainly keeping a watch on it. I'm looking at that IMAP, a lot of green out there. Let me get to some of the individual gainers, and one of them has to do with a deal that actually happened today. Intracellular, that stock up almost 34%. J&J agreeing to acquire Intracellular Therapies. It's a company focused on treatments for the central system or central nervous system disorders. The purchase price, $14.6 billion or $132 a share. So that's about a 39% premium above the closing price on Friday. Bloomberg, by the way, earlier reported a deal was in the works, so coming to fruition on this Monday. Also, we watched a lot of the healthcare pharma space, JP Morgan Healthcare Conference underway. But Humana was actually in the news, along with a lot of other healthcare plans, I should say, health insurers in particular. So Humana and others with Medicare Advantage plans. Humana alone up almost 7% in today's session. United Health was also climbing. This is after Medicare released a proposed plan that could allow an increase in 2026 payments for the companies. So that explains a big bump in that sector. And then, Vonnie, you mentioned the energy space. We saw energy bump up, newer restrictions when it comes to Russia, some sanctions that we got. And so there's some concerns about the supply. Russia, of course, one of the world's top producers. Well, Baker Hughes up about 3.6%. It's an oil field services and equipment company. It was one of the top gainers in the NASDAQ 100. Susquehanna raising the firm's price target on Baker Hughes to $53 a share. Stock closing just under $45 a share in today's session and keeping a positive rating on the share. So that was one of the other individual gainers in today's session. Tim, over to you.
Okay, those stocks in the green. How about some in the red today? Apple among those mega cap tech stocks driving the S&P 500 and NASDAQ lower today. Finishing the day down by a little over 1%. We got some news early today that Apple sold 5% fewer iPhones around the world. It lost ground to those Chinese rivals in the last quarter of 2024. This according to data from Counterpoint Research. Analysts say this was partly due to the lack of availability of Apple intelligence features in China. But one thing we also know is that those Chinese-made smartphones that are competing with Apple, with Samsung, like Xiaomi, for example, and also Vivo, are starting to eat into those companies' business. Apple down by a little over 1% today. Shares of Moderna absolutely sank today at one point to their lowest level going back to April of 2020. Yes, that was before the company even came out with its COVID vaccine that propelled it to a household name. The company cut its revenue guidance for the year. It missed the average analyst estimate. Right now, the company is struggling with slow demand for the COVID vaccine and slow demand for the RSV vaccine. Shares down today by close to 17%. And finally, watching shares of Sonos after we got the news early this morning that Patrick Spence, after 8 years as CEO, is out at the company. He's been there for about a dozen years. The stock initially jumped after that report, but then there was this pullback in the market. It fell as much as close to 11%. It clawed back from those losses this afternoon. Tom Conrad, you know him from Pandora. He was a executive at Snap. He's going to be interim CEO. I don't have to tell you, if you are a Sonos customer, there have been lots of frustrations with the app update and Patrick Spence out as a culmination of those issues. Romain, go ahead.
All right, I just want to get to some breaking news here. Another mover. This is in after hours. Angie, it's a small cap. Shares up about 9%. The company will be spun off. Remember, this is a company controlled by Barry Diller's IAC. The company has announced plans to formally spin off Angie. IAC is also saying that the CEO of IAC, Joey Levin, will depart after that spinoff. And they're saying in the press release that they do not plan to appoint a new CEO and that the CFO and COOs of those companies will report directly to Barry Diller, who is, of course, the chairman of the company. So effectively, they're saying that there won't be a CEO. We'll see how long that lasts. But of course, probably more significant for Angie investors, a spinoff of that company, something that's been long talked about here, piecing apart this empire that Barry Diller has built. Meanwhile, we do want to turn back to the yield space. We talked a lot about how the move in yields has been driving the move in the markets. And I want you to take a look at that 10-year yield, 4.78 and change right now, up about 3 basis points. And this is now the 7th straight day that we've seen a rise in 10-year yields. We haven't had a sell-off like this since at least May of 2023. You saw similar moves across the yield curve here. Your 5-year up about 3 basis points, your 30-year up about 2, your 2-year, that's the most rate sensitive, of course, only up about 1 basis point on the day.
Yeah, a lot of certainly, whether it's inflation, concerns about the deficit, right, and other pressures certainly weighing on the U.S. Treasury trade. Having said that, let's get to some of the stories that are on top of mind, or at least just caught our attention on this Monday. And this one, I think, is maybe for you, Romain. Ryanair coming out and demanding airport booze limits to deter unruly flyers.
So it's fired, literally.
2-drink minimum, or maximum, I should say. 2-drink, minimum.
There we go. Some might say you need a couple drinks to.
Oh, man, it's only Monday, everybody. 2-drink maximum at airports to reduce passenger disruptions and improve behavior on flights. Listen, they're talking about one incident back in April of 2024, Tim, that resulted in about $15,000 in extra expenses.
Isn't this more a question for Bonnie? I mean, she's from Ireland. This is an Irish carrier. I'm not going to go there, but
there is no one
Bonnie,
like
do you want to go there?
To know our limits. We know our limits. I think we can safely say that about the generalized Irish population of the globe. But the other thing, Carol,
I couldn't do that to you, Bonnie. I just couldn't do it to you.
Well, the thing is, Romain would never ever travel Ryanair. It's a budget carrier, right?
Gosh, are you kidding me? Yeah.
Exactly.
He wouldn't be caught dead in a Ryanair airplane.
I stick to the Gulfstream, you know that. I mean, look, you got to do something to kind of keep passengers in check. And let's face it, this isn't just a problem at Ryanair. I think we've all seen this on other airlines as well. I don't know. I don't know if a limit is the answer, but you got to try something, I guess.
They start doing crazy things when they're drinking too much, like throwing their iPhones.
I'm
just making that up. I was trying to give you a segue.
It is funny that you mentioned iPhones, Carol. I know you put that in there for me especially as well, because we were just chatting earlier about how, interesting it is that the numbers are dropping in China, particularly, and that's impacting the stock. Tim, you mentioned it earlier as, a faller. I mean, obviously, there are all sorts of other phones, and Chinese phones from Xiaomi and so on are extraordinarily popular in China, but this seems to be exacerbating and getting more exacerbated by the fact that Apple Intelligence, their AI offering, wasn't even available in China yet.
Yeah, I think that's certainly a big part of this, but also I think a bigger part of this has to do with the iPhone's competitors that are made in China that you can get for less money hold a really good candle to what you can get from Apple right now. And I'm wondering if, the days of Apple being the runaway leader in that country, if those days are numbered.
Yeah, it's a good question, right? We've always talked about how important the market is. We talked with our Mark Gurman, though, and he said, kind of get ready for 2025. There's some interesting stuff coming our way out of Apple. So we'll see whether or not that picks up some of the slack, maybe with maybe lower iPhone sales, at least globally and in China. All right, we got to run. That's a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. We'll see you again, same time, same place tomorrow.
All right, stick with us. Earnings season, it starts. KB Home expected to report any moment now. We'll have those results for you when we come back. Stick with us. This is Bloomberg. KB Home earnings are out. It looks like a beat on revenue, deliveries, and EPS. EPS in the fourth quarter, $2.52. The street looking for $2.44. Revenue at $2 billion. Street for looking for $1.99. Deliveries coming in at 3,978. Street looking for 3,904. The forecast, though, maybe causing a little bit of concern. Average selling prices, the companies say, will probably be around $488,000 to $498,000, and revenue for the full 2025 year, $7 billion to $7.5 billion. The street has an estimate on average that's right in between that at $7.27 billion. Drew Redding over at Bloomberg Intelligence, who covers home builders for us, joins us right now to talk a little bit about this report. And still looks like this is a company running on all cylinders, at least when I look at the top line numbers. Drew, what's the one thing that jumped out at you first?
Yeah, so from an order perspective, things look pretty good. They did exceed consensus expectations, but the number we're looking at is gross margin. Looks like it came in a little bit light, both for the fourth quarter and in terms of guidance for 2025. This echoes what we heard from Lennar recently, and that's with higher rates, home builders have had to keep their foot on the gas pedal in terms of incentives, and we think that's going to continue to weigh on profitability as we head through 2025.
We'll obviously hear more on the conference call, but anything about new developments that might change now, given that we're in a higher for longer environment, Drew?
Yeah, that's certainly for a risk for the builders. If you look at when the Fed first cut rates back in mid-September, you have mortgage rates up more than 100 basis points since then. So the math has got a lot more challenging for buyers just in the course of 3 months. When we were coming into the year, the expectation was the Fed was going to cut rates, mortgage rates would fall and demand would pick up. But it looks like in order for builders to keep the volume flowing, they're going to have to keep their use of incentives elevated. And like we said, I think the biggest risk looking into next year is that margins remain under pressure, not only from incentives, potentially base price reductions, and the potential impact of higher labor costs, depending on which way immigration policy goes.
When we talk about this idea of kind of where homes are getting built, kind of explain, what is exactly KB Homes? Do they kind of have a sweet spot where they build, and do they ever sort of expand beyond those areas?
Yeah, so predominantly the large-scale public home builders build along what we call the Smile Estates from the southeastern U.S. around the south and up through California. KB Home has a heavy presence in California, Texas, Florida, so they're really in the strongest long-term growth markets. I think that's really where they're focused. For them, the emphasis is really on expanding their share within their existing footprint rather than expanding to new ones. There's only a handful of builders who have any significant presence in the Midwest and Northeast, which on a structural basis are kind of more in decline, but have been more resilient over the last couple of months.
All right, Drew Redding over at Bloomberg Intelligence. A closer look at KB Homes, a jump in EPS, revenue up about 19%, though the backlog down about 20%. Nevertheless, shareholders bidding prices up here in the after hours trade as we take a broader look at the housing market and some of the data coming out of Redfin that actually shows home tours rising modestly to start the year. However, the real estate company warns it hasn't necessarily translated to more home sales yet. And one of the more interesting data points was one on housing affordability. Daryl Fairweather joins us right now, the chief economist at Redfin. And I want to start with the affordability question because Drew Redding kind of touched on this with interest rates remaining elevated at a time where we thought they were actually going to be coming down. Your data shows that housing affordability actually improved, or at least didn't worsen, for the first time in 4 years. Why?
It got ever so slightly better in 2024 because the housing market slowed down, mortgage rates stayed stable, but incomes went up. So that allowed people to make affordability gains. But looking into this new year, I don't think that's going to last. I think we're going to be in the situation we've been in where affordability has been worsening.
I mean, we talk about what you need to make in terms of income to even buy a home on a national level. I mean, let's not even talk about New York. On a national level, Daryl, I mean, what is that number?
So the median earner needs to spend more than 30% of their income in order to afford a home. And that's because housing affordability has become detached from incomes. We have this supply shortage where we have not been building enough homes, and that has allowed incomes to rise not as fast as home prices have been rising. And then add on top of that high mortgage rates, the affordability situation has gotten much worse since the pandemic.
Daryl, are there areas of the country where mortgage rates have come down?
Well, mortgage rates are up. They are even up just today, according to Mortgage News Daily. So unfortunately, that piece of affordability has been getting worse. There are some parts of the country where prices have come down. So Austin, for example, prices peaked back in 2022, and now home prices are very similar to what they were in 2021 in Austin.
How is Redfin looking at the possibility of whether Fannie and Freddie might come out of conservatorship, or if that's even on the cards?
Well, if that happens, we're anticipating that mortgage rates could rise more, since there wouldn't be that federal guarantee of that mortgage debt. But we might see more innovation in the mortgage market. More types of people might get access to mortgages. I'm thinking about entrepreneurs who usually have a hard time demonstrating that they can get a conventional loan. We might see more mortgage products for people who look a little bit less conventional.
So, Daryl, I have to ask you a sensitive question about what's been going on in Los Angeles with the wildfires. There's been a lot of anecdotal conversations here about the rental market in Los Angeles, some concerns from some folks here that there is price gouging going on. I'm wondering if you have a read at all on what we're looking at. We're talking about hundreds of thousands of people right now are at least away from their homes. Some of those people are going to come back to no home at all. They're going to need to live somewhere here. And I'm wondering how that impacts the rental market when you have so many people looking for accommodations at the exact same time.
Yeah, so there aren't that many available rentals in Los Angeles. The number, and this is a bit of an old estimate, is about 80,000 rental units available, vacant right now, that could be moved into. And we're seeing numbers that 12,000 properties have been destroyed so far. So the number of people who may need additional housing while their housing is basically uninhabitable, that's going to put pressure on rents. It does make up enough people that we should see pressure on rents over the next year, potentially over the next 3 years, while it takes time for the existing housing stock to be rebuilt. And that's going to hurt not only the people who are looking for rentals right now, but people who are on the margin of being able to afford their rent as it is. They could see their rents going up when their lease is renewed. So this could have some significant impacts on the rental market in Los Angeles.
All right, Daryl, thank you so much for joining us today. That is Daryl Fairweather, Chief Economist at Redfin. And Romain, I think you asked a very pertinent question earlier about whether some of these areas will be rebuilt as they were at all.
Yeah, and at the rental market, it was kind of something that wasn't on my radar. And then Jason Oppenheimer, who's kind of one of the stars of Selling Sunset, came out basically kind of alleging that he's seen price gouging. We haven't actually confirmed that, but it raises the issue, though, of just supply and demand. You have so many people that are going to need accommodations of some sort, and the supply is there. This was already one of the more expensive rental markets out there, and it raises a question as to where these people are going to go. Are they going to stay in LA, or are they going to look for other places to live?
Exactly, and it's not just those people whose houses are now completely gone, it's also evacuees just in general. All right, coming up, the run-up to Donald Trump's second term entering a new phase with a series of confirmation hearings on deck. We'll discuss next with Wendy Schiller of Brown University. This is The Close on Bloomberg. We're just 1 week away until Donald Trump's inauguration. The run-up to the president-elect's second term entering a new phase now with a series of confirmation hearings set to kick off this week. Joining us now is Wendy Schiller, political science professor at Brown University. And Wendy, the list is incredible. I mean, we get Pete Hegseth, we get Marco Rubio, Kristi Noem. I mean, at least another dozen, at least set to kick off this week. How many of them will hit speed bumps along the way, and how many of them do you think will just be plain sailing?
Well, Vonnie, I mean, I think we're watching, Marco Rubio will go through. Kristi Noem, governor of South Dakota, she'll go through. It's really the Hegseth nomination. That's really where sort of the firewall for the GOP is. If Hegseth goes through and that hearing looks like, enough Republicans, particularly Joni Ernst of Iowa, facing re-election in 2026, if she looks like she's going to go for Hegseth, then he's going to go through. Then you think about Tulsi Gabbard, maybe does she go through or not go through? But certainly a week from the president's inauguration, second inauguration, his own party doesn't want to serve up any embarrassments for him. So we're looking for clues here on whether they push forward some prominent ones, Treasury, Secretary of State, to give Trump some wins. and maybe hold off on some of the more problematic nominations. And Robert F. Kennedy could be problematic and he could go through, but I don't think he'll be the first person confirmed by the Republican Senate.
Yeah, for sure. And it could be a long process, some of these. You talked about giving Trump wins. I'm just curious about some of the raft of orders that we've had out of the White House in recent days, including fresh sanctions on Russia, for example. We also had curbs on chip exports come out today. I'm wondering if the current administration isn't handing, a bouquet of roses to the Trump administration and giving it leverage for what it might want to do in the first few days in office.
Well, I think the Biden administration wants to at least leave the country in a pretty good negotiating position with its competitors or /rivals /enemies. But, the Biden administration also extended temporary protected status, I believe, to over 1 million people who are in this country for another 18 months, which should give them protection against deportation or reversal by the Trump administration. So there are things that the Biden administration are throwing in there that are really Biden priorities, not Trump priorities. And, you see the economic meeting the policy in terms of, the idea of deportation, going after people who are undocumented. How does that bump up against these confirmation hearings, but also against, speeding up the tax cut bill? These things can interfere with each other. So the question is, how is the Trump administration planning to stagger these to make sure that the party sticks with him in both the House and the Senate?
Yeah, well said, Wendy. I am curious that once we get through these hearings and stuff, Trump has talked a lot about how he's going to issue a lot of executive orders to implement some of the things he wants, do away with some of the things that he didn't like with Biden. I remember when he first came in back in 2017, 55 executive orders. During the year, he's actually implied that he might do something close to that on day one. Is that possible?
Well, it's executive power, Romaine. And all presidents issue executive orders, going back to Bill Clinton, if those of you remember it. All of them use that power. And most presidents find Congress to be an annoyance. They don't like, even go back to George Washington, they don't like Congress. They got elected. They want to do what they want to do and accomplish their own goals and agendas. So, he'll use that power. Now, where there are difficulties, people will file suit who have, been injured by these executive orders, and they will try to block them or slow them down. But ultimately, for the quote unquote travel ban that the Trump administration tried to do, 2 or 3 times it took them, but they managed to get it through. It took them 6 months. So I think the president's going to come out swinging. He's going to dare people to stop him. But there are Republican senators that are already saying, maybe we don't want the military to enforce immigration law. We wouldn't like that. I think there's signal sending going on publicly and behind the scenes of the Trump administration. There are lines we don't want you to cross in these early days.
And of course, Trump is going to have some other issues also to contend with here as president, of course, as we're dealing with some major natural disaster going on out west. We're now learning from the Wall Street Journal, Wendy, that Trump is planning to visit California as soon as next week.
Well, it's really important that Trump not be vindictive against a state that did not vote for him. A majority of voters in California did not vote for Donald Trump. But this can happen anywhere. We've seen it in North Carolina, for example, Florida, Louisiana. This is happening and will happen all over the country. And to start his administration, I don't think the president, with his highest historic approval ratings that he's ever had, wants to look insensitive to the plight of a lot of different kinds of people who are now in really, really personal distress.
Wendy Schiller, political science professor over at Brown University. And on that point, of course, that will be a big test of his administration coming in, not necessarily dealing with what he promised on the campaign trail, but of course, dealing with the devastation in California in the here and now. Fire containment efforts are continuing in Los Angeles. When we come back, we're going to give you the latest on the damage and maybe possibly the recovery. This is Bloomberg. You're taking a live look right now at Los Angeles, California, the neighborhood of Altadena. Of course, one of the hardest hit areas of the wildfires that have been raging now for days. The Eaton fire, only 33% contained right now. And of course, that Palisades fire that has shown so many dramatic images, a very wealthy enclave that abuts Malibu, Brentwood, and a few other neighborhoods, only 14% contained right now, Vani.
It's incredible, and they've been at this for days and days, and it's going to get more and more difficult throughout the week as the wind gusts continue. So Obviously, we continue to think about everybody that is fighting these fires. Well, as they continue to rage, the disaster threatens to upend the fragile balance between climate risk and home insurance in California. That story is part of The Big Take. And joining us now from Los Angeles is one of the reporters behind the story, Bloomberg's Michelle Ma. So, Michelle, just give us the short thesis of the story.
I mean, I think the short piece of the story is we're still not out of the fire yet. We're going to see increased wind potentially today through Wednesday, and so we're still living it. But what we know now is that this fire so far has been catastrophic, and in some ways it's the worst nightmare for insurers. 7 out of the 12 biggest insurance companies have limited their coverage in the state in the last couple of years, and that's partly due to the climate risk and wildfire risk driven by climate change. And their worst fears are kind of unfolding right now, right before our eyes.
Your story was fascinating, Michelle. One thing that really struck me was this idea that as California, the government, tried to sort of create laws and regulations that would keep the insurers in the state and also at the same time keep policies relatively affordable. There was this discussion about why insurers weren't able to factor in the potential costs, i.e. taking into account those climate risks going forward, rather than having to just base their rates on historical fires, historical disasters.
I think it's really hard to say. I think right now what we do know is that we're going to continue to see the risks of fires like this in the future, unfortunately. Looking at our climate and weather models, California and Southern California is going to continue to see dry, windy conditions that we haven't seen before, and there's going to be more of this potentially in the future. And so far, I think JP Morgan Chase recently estimated that the liability to insurers, the cost to insurers could be more than $20 billion. We've seen even higher estimates from AccuWeather. And I've talked to lots of folks on the ground who are living and dealing with this right now, people who have lost everything and are having to rely on their insurance companies for the first time. Some of these people who are on the FAIR plan, which is the state's insurer of last resort, when other insurance companies won't cover you, that's where the FAIR plan steps in. And I've talked to FAIR plan policyholders who have lost their homes, and they're concerned. They're very concerned about if their insurance company is going to come through and compensate them for what they've lost and allow them to rebuild their lives. And I think that's a big question on everyone's minds right now is what's going to happen, how is this going to play out, and it's really uncertain at this point.
Yeah, Michelle, wonderful reporting. And let's talk to somebody, a former resident of that area. Peter Kalmus is a data scientist at NASA's Jet Propulsion Laboratory. For about 14 years, he called Altadena, California, home. That was before he decided to move 2 years ago due to concerns over the wildfires. Peter joins us right now from his home on the East Coast of the United States. And we should point out, Peter is speaking for himself and not on behalf of NASA. And Peter, I just want to take a moment here before we get into some of the causes here to just ask you, did you have fire insurance when you were in Altadena? And if so, through who?
Well, first, I want to say these kinds of disasters are not potentially going to get worse. They are going to get worse because they're driven by physics. We're on a planet that is getting hotter every year. Yeah, I had fire insurance. Things have been getting hotter for 14 years since I lived there. Heat waves have been getting worse. Droughts have been getting worse. Fire weather have been getting worse. And it was getting too hot and too fiery for me, so I left 2 years ago.
The insurance companies seem to know this, at least based on public records that we can look at. They've clearly been concerned about this for a while. Why did we not see the same level of concern, at least publicly, among some of the other industries and, more importantly, some of the governments, or did we?
Well, so I'm a climate scientist. I've been a climate scientist since 2012. I've been trying my best to sound the alarm. I've been doing everything I can think of. I've even engaged in nonviolent civil disobedience. I've been arrested 3 times. It's been impossible to break through to the public in a meaningful way in terms of sounding the alarm about climate change, even though to climate scientists, it's absolutely urgent. We see it as an emergency. with the public not treating this over the past several years as an urgent issue, it's not surprising that we're still seeing policymakers being elected even today who are anti-science and who say this is a hoax. This is absolutely not a partisan issue. This is physics. This is science. I feel like the media has not done a great job up until now in terms of letting the public know how serious this is, that this is caused by fossil fuels, by oil, coal, and gas, that the fossil fuel industry has been lying since the 1970s, spreading disinformation, blocking action, and that all of these impacts, not just the fires, but also the heat waves, the flooding, impacts to our food system, storms, worsening storms, all of this will get worse in the future because they're all driven by increasing planetary heat.
You know, there were many conversations during and post-COVID, some people not wanting to even have kids, for example, because they were worried about the impact of climate change on the next generation. But then other people moving to any area they chose, even if it was potentially not the safest area, Miami, for example, because now is when you should live. You should live now. So how do you get a consensus around what to do, how to live your life? And is that necessary in order to turn back the dial on some of this climate change?
Well, the only way to stop the planet from getting hotter is to end fossil fuels, unfortunately. It's going to take some time to transition away from fossil fuels, even if we are unified and agree that that's something that we have to urgently do, which as a climate scientist, I can tell you that is the one thing that will make us safer is if we end fossil fuels as quickly as possible. Unfortunately, there's been so much disinformation. There's still gaslighting from the very top amongst the policymakers, mostly Republicans, I should say, who are still telling their constituents that this is a hoax. I am hoping that these sorts of disasters, it's tragic that this is what it takes because the science has been clear for decades. But I think that these sorts of disasters will wake up the public. Once the public realizes that we are in fact on an overheating planet and that the overheating is caused by fossil fuels, and we agree that this is an urgent thing to address, I feel fairly confident that we will quickly transition away from fossil fuels. And then however hot the planet gets, we're increasing at about 0.1 degrees Celsius every 3 years, which doesn't sound like a lot, but you're seeing the impacts of that right in front of you right now.
Well, forgive me for asking a dumb question, Peter, but if we do get to that point where the public does finally embrace this idea of what needs to be done, will it be too late?
No, it will never be too late. We are losing more every year as the planet gets hotter. Once we end fossil fuels, scientific consensus is that the planet will likely stabilize at however hot we allow it to get at that point. So remember, it's increasing at about 1/10 of a degree Celsius every 3 to 5 years. There's been an acceleration in the last 10 to 15 years. Now it looks like it's increasing at about 0.1 degrees every 3 years. So the cooler we allow the planet to, the less we allow the planet to heat up, the safer we will all be, and the more we can minimize these sorts of impacts. But unfortunately, we should have started this 20 years ago in earnest, and it is going to be a bumpy ride from here, I'm sorry to say.
All right, Peter, I think that's where we end it today. We really appreciate you coming on and telling your story. Peter Kalmus is a data scientist at NASA's Jet Propulsion Laboratory and a former resident of Altadena, California. And climate change is, well, affecting a lot of industries, including the ski industry. It's a lot of headwinds, in fact, affecting the ski industry right now. We're going to talk up ahead here with a couple of folks in that space here about, well, maybe how you improve it. Some novel ideas out there. That's coming up next on The Close, right here on Bloomberg. The U.S. ski resorts are trying to dig themselves out from some of the challenges bogging down the sector, be it climate threats plaguing parts of the West Coast, labor disputes, and issues with management. Investors are still trying to make sense of a tentative deal that was struck between Vail Resorts and the Park City Professional Ski Patrol made last week. Joining us now to talk a little bit more about that is Gordy Megroz. He's a Bloomberg Businessweek contributor. And Gordy, I was a little curious about this strike. It was a short-lived strike, but a lot of us saw the images, of course, over that kind of Christmas to New Year's period, which is typically kind of one of the busier stretches for skiing. And we saw those long lines because probably some of the most essential workers weren't working. And this was all over a $4 an hour pay increase. Is that right?
Yeah, it's hard to believe. I know.
So give me a sense here. I mean, we talk about Vail, which has become kind of the dominant player in the ski industry, at least the corporate ski industry. And I am curious about the business model and what they're trying. I know they want to keep costs down. That's everyone's business model. But there has to be some distribution of that cost based on who's most essential to keeping things running and, more importantly, keeping things safe.
Yeah, it's hard to understand what Vail was thinking in this instance. They are a publicly traded company. They're one of the few publicly traded companies that's in the ski business. So they do have shareholders to answer to. But in this instance, it really left a lot of us scratching our heads because Vail is already a company that has a lot of bad press, and this caused even more bad press. They were unwilling to negotiate with ski patrollers over a $4 per hour pay raise, which because they didn't have that ski patrol staff during the holidays, they couldn't open the terrain that they would normally have open this time of year. And so as you said, long lines. Yeah. Just a diminished ski experience for their customers.
Talk about ski experience overall, Gordy. I mean, you've been a journalist covering the ski industry for years now. And if you talk to old timers, kind of people from my parents' generation or my grandparents' generation, they talk about a much different ski industry that was a little bit more familial, certainly a lot cheaper, and one that was a lot more accessible. And we've entered an age where most of the ski resorts now have been taken over by either corporations or private equity to some degree or another. And there's been a change. I'm not saying it's necessarily for the worse, but it's certainly changed that experience.
Yeah, I don't think it's not hard to argue with the fact that consolidation and the sort of corporatization of the ski industry has diminished the product that you get when you go to these ski areas. They feel a bit more homogenous. They feel corporate. And you're also, because there are fewer corporations that own these ski areas. There's really two big players in the U.S. It allows them to sort of compete with each other, and it allows them to raise prices along with each other. And so the ski experience has become, it's very expensive, much more expensive than it was when I'm sure you and I were kids and skiing. But it's a different feel at the ski areas. There's a lot of people are sort of being turned off by this, trying to avoid Vail resorts and go to ski areas that are independently owned.
Gordon, briefly, why is it so difficult to make these work? I mean, I feel like if you're a skier, you're a ski fanatic for the most part, right? You're not going to go a winter without going skiing at some point. So these ski resorts should be able to up their prices, thereby making their margins.
Yeah, I mean, it's hard to say why they're, skiing. Running a ski area is incredibly expensive. There's no doubt about it. And the bigger you become, the more expensive it becomes. A chairlift, we're looking at chairlifts right now. Installing one of those chairlifts is, a $10-15 million proposition, and they have to replace them every decade or so. So, and then, if you're adding more terrain, which is sort of what ski areas use as a marketing tool, adding more infrastructure, the price just goes up and up. So yes, it's very expensive to run a ski area. Vail has done an incredibly good job of figuring out how to draw users in and they sell a pass that is good at any number of their ski areas, and it's a fixed cost, and they sell it early, and that gets them revenue right off the bat. So then when you get there, they sort of get you on the food and the lodging and all that other stuff. Vail, and a lot of ski areas operate this way. They own a lot of the infrastructure, a lot of the hotels, a lot of the restaurants.
All right, Gordy, great stuff. Gordy Megroz, he's been a writer on the ski industry for years now. A great book and some great articles about just how much the ski industry has changed. And we're going to continue that conversation when we come back after the break, because Bode Miller is also trying to change it as well. Of course, he is a legend in the world of Olympic skiing, and he actually has a new product out. You don't want to miss that. That's coming up next, right here on The Close. All right, we continue our conversation about skiing, and we want to talk about a new venture called Peak Ski Company, hoping to expand its presence with its high-quality equipment and some snazzy designs. Pleased to say that the duo behind that endeavor joins us right now. Andy Wirth is the founder and chief executive officer, and Bode Miller, who really needs no introduction, of course, the most successful U.S. men's alpine skier in history. All right, let's get right to it, and I want to start off specifically with the skis that you guys have invented, that you guys are selling. What's different about them than regular skis?
Yeah, I mean, I think it's part of the evolution that I saw going back to the 90s, which was keeping skiing fun, exciting, enjoyable, and safe, moving people forward in the sport. So side cut was a huge move, right? It got people reinvigorated. It sort of stopped the slide towards snowboarding. Nothing against snowboarding. But the keyhole technology is kind of central to our methodology of how you make a ski turn and be forgiving and be really versatile. So it works on, more different types of conditions and terrain for every different type of skier. So it was something that was in my head for a long time. And when we brought it out, it was one of those really kind of, I guess, nerve-wracking moments, but really exciting when it worked as well as it did, because it was kind of a rush job when we got the skis out. We kind of launched really quickly, and so to get the recognition and have people recognize that not only was it really good, like a high quality ski, won a bunch of awards, but it was notably different, very different than what else is out there. And I think in a world that's kind of homogenized over the last couple decades, it was cool to stand out a little bit.
So, Andy, I mean, talk a little bit about, what you've done so far to raise money for this company. How difficult has it been? Have people been receptive to this idea?
Romain, good to talk to you, and thank you for having us on. And the answer is simple. We've had some great successes and some challenges in the current market conditions in the past year and a half, simply put, on capital raise. But I got to tell you, on the consumer markets, we've done very well. As Bode mentioned, we won a great number of awards. We came out of the gates 2.5 years ago or so, and within the first year, won a slew of awards and had great demand for the product. Mostly because Bode came up with something very unique, very different, that changed the skis and how they ski. What is important to understand is we definitely didn't come out of retirement to just build great skis, although we're prideful in the skis. We have 3 strategic initiatives that really underpin the capital raise and the investment strategy thesis, on Peak. One includes Peak Locate, which we just announced, as you know, last Thursday at CES. And then we have 2 others that we're working on that really are quite substantial. And as I sometimes say, my best version of Yogi Berra is the least important thing about Peak Ski Company are the skis, but they're critical. These other initiatives are really what add enterprise value. And once we find we have a chance to talk to folks about investors, about our these initiatives, they tend to understand it quickly and tends to work out quite well, frankly. So we've had some successes. Yeah. We've had a couple challenges here and there, but we're actually doing quite well overall.
So it seems like there are at least 5 Peak by Bodes, and they're about 869 retail, just to put that information out there. But Bode, I'm more curious about your time as an investor and an entrepreneur, because that's been going on for at least 15 years. Do you have a couple of lessons for people when it comes to taking on something this difficult?
Yeah, I mean, it comes down to the team. Obviously, like I was confident from the beginning that I could build good skis. I've been doing that for 35 years, honestly. So, I think Andy had confidence in that. The team we built around it was designed to facilitate the economic path, right? Like, I mean, you have to be viable. You have to be able to show a return for investors. You have to be able to demonstrate longevity and sort of have a path forward. I think a lot of businesses that I've seen, that I've invested in, that I've both successfully and less so. That's the challenge. Is this the team? How does it hit the road, right? Like I come from an individual sport where it's all me, and that's been the big transition into my sort of business life is putting together really quality team components that all join together and pull in the same direction, because these aren't things you can do by yourself, especially not at scale. So I think we have a great team. The product is almost secondary in a lot of cases. Like you see, great marketing can sell just about anything, but if you want the longevity and you want the ultimate success, it has to all pair together.
All right, guys, we're going to have to leave it there. I wish we had a little bit more time. We have to get you back on when we have a little bit more room here. Up against a commercial break, Olympic gold medalist Bode Miller there, and Andy Wirth. They, of course, run the company Peak Ski, and you definitely have to check out some of these products. Vonnie, I don't know if you've ever seen, I haven't actually seen them in person here, but I'm intrigued. I actually like the locator stuff, because I'm like one of these people that, I go off, my wife puts her skis in one location, my skis in another, and we can never find them. They all look the same. I don't know.
I mean, for $869 for Peak by Bode, you don't think that's a steal, no?
No, I mean, for skis,
deserves,
they go a little bit higher than that.
That's what I'm saying. I'm saying
we have to get you out on the slopes.
It's cheap. It's a steal.
I know, it's good. All right, we really appreciate you joining us here on The Close. We'll be back tomorrow with all of your market-moving action. In the meantime, for your politics coverage, stick around. Balance of Power is up next, right here on Bloomberg.